Okay, obviously, this is a simple P&L uh, statement that shows that you have revenues, expenses, and a net income, and it shows I brought in 10,000, I spent in salaries, rent, insurance, and basically I had 2860 profit, which is fine. But it's the good thing about the profit and loss is made on a base of a of a period. The period can be 1 week, 15 days, 30 days, whatever the period you want. Could be 3 months, 6 months, 1 year. Okay, and the start of the period is always goes back to zero. You can calculate it as going back to zero or year to date, meaning it is a cumulative. Okay. Again, any questions? Please, if I'm losing you or you have any question on any of these topics, you're more than welcome to put it on the chat. Okay. Now, the next piece here is income statement. Like I said, it's the revenue, the profit and loss. Now you have to make sure that it does not include AR. That's the main difference between cash flow and P&L. This is how one would normally look at a proper P&L. You have your sales, cost of goods sold, gross profit, G&A, net income, income tax, net income after taxes. This is how you kind of a real one. The one we do here is just to show you the logic or the concept. This is how it may look, and this is just for a small art company. You know, how much of the art, the cost of sales is how we're going to concentrate on this segment, because we want to be able to look at what your cost is, okay, on generating direct cost to generating that sales. And in the case of here is obviously he's getting art and he's looking at the canvas, his paint, supplies, frames, studio, payroll, taxes. Those are direct costs associated to making that sale. G&A, or general selling and administrative expense, is basically operational costs, which is your rent, office, telephone, and so insurance and so forth. Okay. Now, what do we look at profitability and the balance sheet? The balance sheet basically is assets, which is all your current cash, inventory, accounts receivable, fixed property, vehicles, machinery, liabilities, everything that you own in 1 year, and long term is everything that is owned over 1 year, 12 months or higher. Equity, if you put in some money or you got an investment or anything, will be up here. Retained earnings is profit over the year. The best way to explain this is we can look back to the Miami Dolphins season, and we can say they started the season, I think so it was 1966. We can do all the plus and minuses of the Miami Dolphins since 96 to today. And that will be part of all the pluses, all the wins and losses. It will give you a net amount since day one of your business. So all the profits that you created, all the loss will kind of add and subtract itself over the years. If you have 5 years, over 5 years. If you have 30 years in business, over 30 years. Now, why is that important? We're looking at this number. If this number is negative consistently, that means either you're draining capital from your company or you never really made money. So why would somebody give you money if you always lose money? Always losing money or draining the capital from the business, okay? Now we have this formula, equity is equal to asset less liability. And another easy way of looking is asset is equal to liabilities plus equity. So this A is equal to L plus E. And maybe the easiest way to put it is if you bought a truck for for delivery or for your catering. You bought a truck, it cost you $20,000. You put $2,000 as a down payment, and you borrowed 18. Basically, you got a 20 for the vehicle. I owe 18,000, and I contributed 2,000. And that A, which is 20, 18 plus 2, the equation balances. And this is an equation, simple equation that all accountants and everybody in bookkeeping or anybody in accounting needs to make sure that it balances. That's why when you see your financial statement, this is equal to the sum of these two. Now, this is how an example of a balance sheet. You have your cash, accounts receivable, supplies, prepaid, equipment, and so forth. And then this is your total. Liabilities is this, and you can see it totals equally. Common stock, you put $10,000. Retained earning, he's been making $2,360. All of that. Now we'll see how this thing connects and how we get this 2,300 here shortly. But this is what you owe, how much you owe, notes payable, salary payable, unearned service revenue, and so forth, interest payable. But this number, retained earning, comes from another place. So we'll show you here shortly how this number is created.